Outstanding!
Hello everyone, I'm Jelena Stojanovic. Welcome to Arpin's International Insights, the part 2 of our 4-part series that is focusing on expats and their taxes. Once again, our guest is Mr. Olivier Wagner, a tax expert and CEO of 1040Abroad. Today we are going to focus on taxation challenges and rules from various countries. We'll learn more about the most common mistakes and misconceptions that expats make while preparing to file their taxes from abroad. Also, we'll learn what is a foreign tax credit. These are all good things to know if you're living or deciding to live outside of the US. That is why we are inviting you to watch International Insights today. Let's begin. Is there one particular country when it comes to filing taxes for your clients that is more challenging than others? And if so, what makes it that way?
Generally speaking, countries with a lower tax rate than the US, such as Singapore, Hong Kong, or people who don't file tax returns elsewhere. People who are in this gray area, digital nomads, move from place to place for which it will be inconvenient to file tax returns as well, and for which the risk of enforcement is fairly low because they keep on moving around. For those, the foreign tax credit only gets so far because, again, we won't fully offset the US tax rate with the dollar for dollar credit for taxes paid elsewhere. And so we have to rely more heavily on the foreign downcamp exclusion, the foreign housing exclusion to offset their US tax liability. If they earn less than $108,000 of income, we will still be able to bring their US tax liability down to zero. It's just that I have fewer tools in my toolbox to bring them there. If they earn more than that, which is actually fairly common in Singapore, the cost of living is fairly high as well in Singapore. If they earn more than $108,000, they might actually have US tax owing.
Okay, so as the opposite, what country is the easiest when it comes to managing taxes for expats?
Western Europe, Canada, you have an higher tax rate. You can use the foreign tax credit. When you use the foreign tax credit, you have more opportunities to claim the child tax credits. They might actually get a refund of that. Right, so of course, depending on the situation, the foreign income exclusion might be more appropriate, but again, I have more tools in my toolbox, and the foreign tax credit is usually the one we would use. Also, Social Security would be, they would clearly be exempt from US Social Security because there would be a Social Security totalization agreement between the US and those countries, which in the case of an employee is straightforward. If they live elsewhere, if they work for themselves and they live in a country without a totalization agreement, again, we would have to find a way to avoid Social Security, which would have been automatic if they had been in Western Europe or Canada.
Okay, Olivier, and please tell me, what do you hate to see? What are some common misconceptions or mistakes that expats make when it comes to filing and managing their tax once they start living abroad? What do you hate to see?
Why people are not aware of Form 5471 and contact me late regarding that form. So 5471 relates to foreign corporation. There are various categories, but the main one is a controlled foreign corporation that would be a foreign corporation in which at least 50% of the shares are owned by US citizens. Not only is it an involving form, but there are potential penalties for filing it late. So I hate it when people don't know about it and contact me late. What else? Right, the people tend to know about the foreign downcamp exclusion, which allows them to exclude up to $108,000 of earned income, wages, self-employment income. The misconception comes about when they think that means that they don't have to file a tax return, which is not the case. They still need to file a tax return to claim the foreign income exclusion. If they earn less than the standard deduction of $12,000, then they don't have to file a tax return. But there's a long way between 12,000 and 108,000. So that's another misconception that I think.
Okay, so thank you. Another question regarding expats and their concerns, and maybe one step near to the misconception. Do they have to pay income tax to both the country they now reside in or the country of citizenship, or to possibly do both? And how does that work?
Right. Well, I don't want them to pay tax to both. In most cases, they don't pay tax to the US. The way it works is that income would be sourced, quote unquote, to a country, and that country would have first right of taxation of that income, and then the other country would also tax it, but you would claim a foreign tax credit, getting a dollar for dollar credit for taxes paid to the first country. Mm-hmm. So dividends will be sourced where the company paying them is incorporated. Interest capital gains by using the tax treaty would be sourced where the taxpayer is a resident. Employment income or personal services as a self-employed person would be sourced where the work is performed. So if someone lives in France, regardless of who their client or employer is, regardless of them being paid on a US bank account, that income would be sourced to France. They would first pay tax to France and then get a foreign tax credit in the US, which again, in most cases would mean that they would not pay tax to the US. For people who, again, live in countries where the tax rate is less than the US, there's a chance that they would have to pay tax to the US to bring them to that higher US tax rate. They still get a foreign tax credit, but they don't have enough foreign taxes to bring them down to zero. And then, of course, people who have income sourced in both countries would pay tax to both countries, but that's the way it should be. It's not double tax. That some of their income is taxed in one country, some of their income is taxed in the other.
And what is the most common deduction that an expat can take that a normal citizen cannot?
Well, that's the two: foreign tax credit, foreign income exclusion. These are, again, the foreign tax credit is fairly flexible. Essentially, the only requirement is to have paid tax elsewhere. But if the one requirement, and you don't really save on tax, you just pay it elsewhere. The second one is the foreign income exclusion, which requires you to either be an actual resident of a foreign country or have spent 330 days in a 12-month period in foreign countries.
Mm-hmm. And can expats deduct their expats for moving their home furnishings and travel? Is that possible?
It's still available to military members, people work in the military, work for the US government. But there used to be a deduction that's for moving expenses before 2020, but it's, again, only available to people in the military now. Okay.
Can an expat deduct moving their pet, maybe?
Well, I mean, you get to move all of your furniture, etc., all of your assets. So if you're in the military and you move your pet, you buy an additional seat on the plane for your pet. Yes, you'll be able to deduct that, but that's for people in the military.
Yes. Good to know.
Sure.
Okay, good to know. In countries with income tax rates lower than in the US, claiming foreign tax credit is not the most beneficial tool to offset the tax liability Uncle Sam is expecting, as Olivier explained to us. The same applies for so-called digital nomads, people who work and travel around the world. In such situations, a better approach to bringing the taxes owing towards zero is claiming the foreign earned income exclusion option. We also learned that there might be misconceptions when trying to understand IRS filing requirements. Also, claiming moving expenses for moving abroad as a deduction is available only for military workers and for a small group of other taxpayers. Having all the information from the right tax specialist can save you a lot of headaches, time, and money. We hope today's information will help you on your tax journey. You don't want to miss part 3 of our 4-part series with Olivier Wagner, where he's going to share what you need to know when it comes to FATCA, renouncing citizenships, and other important tax obligations. This has been Jelena Stojanovic for Arpin's International Insights, the micro-series that's always moving for you. See you soon!